The 7 Golden Rules of Control Charts. Control charts are one of the most powerful tools in the trader's arsenal, yet many people still think of them as something confined to manufacturing or industrial quality control. Originally developed by Walter A. Shewhart in the early 20th century to monitor production processes, control charts have since made their way into the world of financial markets. Their core purpose is to separate normal, expected fluctuations from unusual or out-of-control variations that signal something significant. For traders, this is invaluable. The markets, like factories, are systems filled with both predictable behavior and unpredictable anomalies. When applied correctly, control charts help traders monitor price action, volatility, and market cycles in a disciplined and measurable way. Financial markets are noisy, unpredictable, and full of misleading signals. Many traders lose money not because their ideas are bad, but because they cannot distinguish between normal price fluctuations and real opportunities. This is where control charts shine. By applying statistical rules, traders can see whether a price movement is simply market chatter or a meaningful event. For example, if a stock has been trading steadily around $100 with normal day-to-day variation of about $2, a sudden drop to $94 may not be just noise, it may indicate a new trend, external shock, or systemic shift. Control charts would highlight this as a violation of the rules, alerting the trader to investigate further. Conversely, if the stock drops to $98, this would be within the control limits and likely not worth reacting to. The 7 Golden Rules provide traders with a structured approach to interpreting these charts. Instead of relying solely on intuition, they can follow a tested framework that has been refined over decades. This prevents overtrading, reduces emotional decision-making, and improves profitability. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 25% off your next purchase. The 7 Golden Rules of Control Charts are: Rule 1. 1 point beyond control limits. The first and most obvious rule states that if a single point falls outside the upper or lower control limit, it signals a process that is out of control. In trading terms, if the price, moving average, or volatility measure suddenly spikes above or below the statistically defined limit, it could mean a new trend is emerging or an external shock has occurred. For instance, imagine a currency pair that trades within a normal daily range of 80 to 120 pips. If, on a given day, the pair suddenly moves 300 pips, a trader using control charts would immediately recognize this as abnormal. The market is signaling something unusual, perhaps a major news release or unexpected economic data. Acting on this knowledge, the trader could either enter trades in the new direction or protect existing positions before losses escalate. By applying this first rule, traders avoid dismissing significant events as random noise. Instead, they treat them as opportunities or warnings. Rule 2. 9 consecutive points on the same side of the mean. The second rule identifies a pattern of persistent deviation from the central line. If 9 consecutive price points land either above or below the mean, even if they are within control limits, it indicates a potential shift in the underlying process. For traders, this could signal the beginning of a sustained uptrend or downtrend. Suppose a stock has been oscillating around a $50 moving average. If 9 consecutive closes remain above $50, even without breaking the control limits, the chart suggests bullish strength is building. A trader recognizing this pattern could enter a long position early, riding the trend before it becomes obvious to everyone else. This rule highlights how control charts can catch early signs of change, not just extreme outliers. Rule 3. 6 consecutive points moving in the same direction. The third rule looks at momentum. If 6 consecutive points trend upward or downward, even within control limits, the process may no longer be stable. In trading, this often corresponds to building momentum that could evolve into a larger breakout or breakdown. Consider a commodity such as gold. If its daily closes gradually increase for 6 straight days without breaking above the upper control limit, this still indicates unusual directional consistency. Markets normally oscillate. When they don't, it is often because a strong force, such as institutional buying or geopolitical tensions, is pushing them in one direction. A trader who understands this rule could anticipate a significant price movement and position accordingly, rather than waiting for a dramatic breakout that everyone else sees too late. Rule 4. 14 points alternating up and down. The fourth rule identifies unnatural oscillation. If 14 consecutive points alternate up and down, it suggests manipulation, inefficiency, or noise in the process. For traders, this often points to a market stuck in a range where direction is uncertain. Imagine a stock that fluctuates between $95 and $105 for several weeks. Every attempt to rise is quickly reversed, and every dip is followed by a rebound. Control charts would flag this alternating pattern, warning traders not to overcommit in either direction. Instead, range trading strategies such as buying at support and selling at resistance might be more effective. This rule helps traders avoid frustration and losses during sideways markets. Rule 5. 2 out of 3 points near control limits. The fifth rule focuses on clustering near the edges. If 2 out of 3 consecutive points fall near the upper or lower control limit, it indicates growing instability. The process is not yet out of control, but it is on the verge. For traders, this often foreshadows a breakout. Take Bitcoin as an example. If prices keep clustering near the upper control limit of $120,000, even without breaking through, it suggests sustained buying pressure. A trader watching for this pattern could prepare to go long, expecting the eventual breakout to the upside. This rule is particularly powerful for anticipating market explosions before they happen. Rule 6. 4 out of 5 points beyond one standard deviation from the mean. The sixth rule warns traders when the majority of recent activity is significantly away from the mean. If 4 out of 5 points sit more than one standard deviation from the central line, the process is unstable. In market terms, this can indicate institutional activity or heavy speculation. For instance, a stock usually fluctuates within 1% of its average daily price. Suddenly, 4 out of 5 closes are 2% above the mean. This would suggest abnormal buying pressure and could be the early stages of a bubble. A trader who recognizes this could ride the momentum but remain cautious, knowing that instability often precedes reversals. Rule 7. 15 points within one standard deviation. The seventh and final rule highlights unnatural stability. If 15 consecutive points all fall within one standard deviation of the mean, it suggests suppressed volatility. In trading, this usually precedes a significant breakout. For example, if the S&P 500 trades tightly around its 50-day moving average for 15 sessions, control charts would mark this as unusual calmness. Traders often say, periods of low volatility are followed by periods of high volatility. The control chart confirms this principle. A breakout, either up or down, is very likely to follow. A trader who spots this setup can prepare stop orders or straddle positions to profit regardless of which direction the breakout takes. By mastering these rules, traders can improve timing, risk management, and overall profitability. Control charts give them a framework to separate noise from meaningful signals. They prevent traders from chasing false breakouts, overreacting to normal fluctuations, or missing early signs of big moves. For example, Rule 2 and Rule 3 help traders identify trends early, while Rule 5 and Rule 7 prepare them for breakouts. Rule 4 warns against overtrading in choppy ranges, and Rule 6 alerts them to overheated markets. Each rule provides actionable insight that can be applied across stocks, forex, crypto, and commodities. The ultimate benefit is discipline. Trading success depends less on predicting the future and more on reacting intelligently to what the market shows. Control charts enforce that discipline by offering clear, statistically backed rules. Conclusion: the 7 golden rules of control charts are more than just statistical curiosities. They are practical tools that can help traders distinguish between normal market noise and significant opportunities. By learning and applying these rules, traders can enhance their decision-making, reduce emotional errors, and improve their chances of consistent profitability. Markets will always fluctuate, sometimes wildly, but control charts offer a stable framework for navigating uncertainty. Whether you are a beginner seeking structure or an experienced trader looking for an edge, mastering these 7 rules could be the difference between random guessing and systematic success. Thank you for watching.